From lower gas prices to potentially larger tax refunds, consumers have some glimmers of hope on the money front in 2026. But post-pandemic financial pressures took a big toll on some credit scores. Karen KVUE looks at the numbers and why they matter.
The Federal Reserve Bank of New York found Americans haven't been this anxious about missing debt payments since the early shock of the COVID-19 pandemic in April 2020. Consumers still feeling squeezed by elevated post-pandemic inflation and debt that came with it.
It is a challenging time, but it's important for people to understand that they have more power over their money and over their interest rates than they think they do.
LendingTree recently analyzed records of 100,000 users with exceptional credit scores of at least 800. They found those consumers averaged $171,553 in debt, including mortgages, up 14.2% from October 2022. Despite taking on a bigger burden than a few years ago, those borrowers paid their bills on time every month. They kept credit utilizations low, averaging just 5.5% of available credit, and limited inquiries for new credit, averaging just 1.7 over the past 2 years. All key elements, Matt Schultz, LendingTree's chief consumer finance analyst, says, leading to a higher credit score.
It doesn't even have to be perfect credit. It doesn't have to be an 800 credit score for you to basically have an awful lot of options when it comes to credit cards, mortgages, personal loans, on down the line.
And in an uncertain labor market, improving a credit score could improve chances of a job or promotion. Only 11 states have laws on the books prohibiting the use of credit reports when making employment decisions, with exceptions for some roles. In Washington, I'm Karen KVUE.